Good evening. Tonight we're going to be talking about corporations. Now, corporations have been in part of our business life for hundreds of years. Corporations have been around since the time of Washington, to tell you the truth. And the corporations are a way of running a business without having the business be yourself. We're going to talk about how you do business as an individual later, but a corporation is an entity that you create that will actually give you certain benefits that you couldn't take if you're doing business yourself. Now, there's two types of corporations. Number one, a corporation is called an S corporation. The second type is called a C corporation. Now, these are just code sections in the corporate code that tell us which type of entity we're talking about. And most of that has to do with how things are taxed. And we're going to talk a little bit about each one of those so you can kind of see how that is. But why do we use a corporation? Why do this? The reason we like to use corporations for running businesses is, number one, they have a long history telling us exactly how they will be treated in certain circumstances, what the courts have decided in the past, how things have been decided, what the code says. We have a really good understanding of what a corporation does. Number two, a corporation is able to get some tax benefits that we wouldn't be able to get if we were running the business through our own name. And number three, the corporation gives us some asset protection. So let's talk about asset protection. This is for either an S or a C corporation. We get the same type of asset protection, except in one case, which I'll explain to you. A corporation, when it is running a business, it takes on the liability for all things that go wrong. So if I work for a corporation and I were to go and let's say I had a corporation and I had a client or an employee even that went out and did something that damaged one of my clients. And so what happens is that client comes and sues, and that he's going to come, and who's he going to sue? He's going to sue me because I own the corporation. He's going to sue the corporation itself, and he's going to sue the employee that caused the issue. So what happens in that case? Well, because we have a corporation, I'm just the owner. I'm not liable for what happens to the corporate clients by the employees of the corporation, unless it's me that does it. So if my client, or not my client, I'm sorry, but my employee were to actually go and cause this damage, I can go to the court and say, Your Honor, I didn't cause the problem. This person doesn't work for me. He works for the corporation. They're suing the wrong person. And the court can actually take me out of that lawsuit. So the only ones that are left are going to be the employee and the corporation themselves. Now, this is a nice thing. It's called the corporate veil. And this is kind of like having a protective screen around the corporation. So whatever happens within the corporation will actually stay in the corporation. They can't get out and come after my house and my money and my assets. It has to stay within that corporation. Now, does it work every time? No. Okay, why? Because there are judges that are out there and they're human, and sometimes they follow the law and sometimes they don't follow the law. Sometimes people who have the corporations don't do what's required to keep the corporation valid, and thus somebody can get through. But if you do everything you're supposed to do, you have a really, really good chance. I'm going to put a 9 out of 10 chance that you are going to be personally protected from what happens with what the corporation does and what its employees do. So that's why we like corporations. Okay, they give us this liability protection. Now, there's other ways we're going to show you that gives liability protection also, but this is one of the ways that we take care of that. So the second thing that we use a corporation for is we can get tax deductions with the corporation that we may not be able to get if we are running a business personally. And once again, depending on whether you have an S corporation or a C corporation, will determine what kind of tax benefits you're going to get. So let's start with an S corporation, okay? S corporations are very simple, okay? They're easy to run, they're easy to follow. There's not a lot of paperwork that you have to worry about. And so what happens, you create this S corporation. At the end of the year, you're going to get a K-1 that says this is your share of the profits. So let's imagine that this S corporation had $100,000 in profits. And so you're going to get a K-1 that says you have to pay tax on $100,000. Now, it could be that you actually brought home that $100,000 and it's in your bank account, and so you should be paying tax on it. The problem is sometimes some of those profits remain in the business in things that we can't actually write off, but they're still seen as profits. So maybe you only brought $60,000 or $70,000 home. In that case, you're going to still pay tax on $100,000, even though you actually were only able to bring home $50,000 or $60,000 or $70,000. So that's kind of an issue once in a while with an S corporation because it uses a K-1. Number two is the S corporation has a great benefit that if you're going to sell the business, and so you're going to build it up and then sell it after 2 or 3 or 4 or 5 years, it might be better to have an S corporation because your tax ramification on that sale may be a lot better being an S corporation than it will be a C corporation. The S corporation has the benefit that you're not going to have to worry about self-employment tax, which if you do things incorrectly in some ways with other corporations or entities, you may have to pay a self-employment tax. And we'll get into that more later. And one more thing is that with an S corporation, we're able to go ahead and take out draws, take out money without actually deducting the taxes yet, and then you'll just settle up on the taxes at the end of the year. So those are some nice things about the S corporation. Let's talk about the C corporation. We can compare the two and see you get some good things with one, some good things with the other. The C corporation, one of the benefits that it gets is what we call a fiscal tax year option, which means that the C corporation can determine to start its year, its taxable year in a certain month, and end its taxable year in a certain month. The S corporation has to go from January 1st to December 31st. C corporation, let's say that we decide that we're going to start our taxable year on April 1st. And so the end of the year will be March 31st. So just give you an example of how that works, of why the fiscal year is kind of nice sometimes. Let's imagine that once again, you have this $100,000 of profit in the corporation. So the end of the year is coming. If you have an S corporation, you've got to decide, am I going to just leave it in the S corporation to continue to be able to help it to grow? And I get a K-1 for that $100,000 and have to pay tax on it anyway? Or am I going to go ahead and take the $100,000, put it into my name, and pay tax? So the deal is you're going to need to pay tax one way or the other if that money is still in or out of the corporation on January 1st. So let's imagine that in a C corporation you have this fiscal year, and so the end of the year is coming. You have this $100,000 profit in there, and since the end of the year for taxes for the corporation is not going to end until March 31st, you leave it in the corporation until your tax year ends. So now we're into January or February. Now you didn't have that money in your checkbook to have to pay tax on it. It was in the corporation at the time, and when your tax year ended. Now what happens is we go ahead and transfer that $100,000 from the corporation into your name in February or March. And now when the tax year for the corporation comes up, it doesn't have the $100,000 either. So the $100,000 doesn't have to be paid, have tax paid on it at that time either. It could be a whole 18 months later before you even have to worry about taxability on that $100,000. And what we do is if it's still there towards the end of the year, you can go ahead and transfer it back to the corporation and go back and forth. It's called juggling the taxes, and it gives you the ability to use the money in legal tax deductible ways so that in the end you may not have to pay tax on all of it or any of it. So that's the nice thing about a fiscal year. S corporations cannot have that benefit. Another thing the C corporation has is it has the ability to pay its own taxes on the profits. So there's no K-1 involved with a C corporation. So what happens is that we've got this $100,000 there, and you get to decide, should I leave it in the corporation to be taxed there because it's got its own tax, it'll pay its own taxes, or should I distribute it out to me and have me pay tax on it? Well, most of the time a corporation will have a lower tax bracket than you do individually. So I'll give you an example. Years ago, and I know the numbers have changed in 2017, and I don't have those current numbers here, but years ago it used to be that if you earned $33,000 personally, you were in a 15% tax bracket. Then when you earned 34, you jumped up to a 28% tax bracket. So twice as much taxes almost. Now, the C corporation didn't jump up to that 28 from 15 until almost $70,000. So you can have like $30,000 taxed at half the tax that you would if you took it into your own name. So that's another nice thing, is it pays its own taxes. Something else we get with the C corporation is that the law allows us to protect the corporate stock from creditors by putting the stock into an entity like the limited partnership we talked about last time. So the deal is, if we put your C corporation stock into the L limited partnership, when they come and try to collect things, they're unable to take your corporate stock. If it's an S corporation, or if you don't put your corporate stock into a protecting entity, then your creditor can come, take your corporate stock, own your part of the business, take over the business, and take the things that are in the corporation. And so that is an issue with that also. So we have good points and bad points on both sides. I would say that 90% of my clients usually will use a C corporation because they want to get the tax benefits that C corporation receives. Now realize we're not even talking yet about the fact that because you have a corporation, there's going to be many, many more things that are going to be tax deductible as a business expense than they would be if you had these expenses personally. You're going to be able to write off things having to do with anything that has to do with your business, okay? Including things such as travel, or paying for employees, or paying for taxes, or some business car expenses, and different things of that sort. These will all be seen as tax deductible. And so you're going to be able to write off more things tax deductible because you have the business than if you did not have the business. So using a corporation, it helps you run the business easily, it organizes things, gives you tax benefits, and it gives you some asset protection benefits. So that's kind of a Class 101 on corporations. We'll be getting into more sophisticated things that you can do with those as we go along with these seminars. So go ahead and come and listen to the next one, and we'll go ahead and show you some more fun things that we can do.